One of my subscribers asked if I would review QYLD, so I took a look up at it and I'm going to give you my review as well as get into some other ETFs as well. Stick around through the video if you're interested in learning about it. Good afternoon. My name is Adam Kahn and I'm the Rational Investor. Today is Saturday, December 2nd. I hope you're all doing well. Little chilly here in Las Vegas. Our neighbors had us up early in the morning. They were cutting down some trees, so not thrilled about that. Anyway, before I forget, before I get into QYLD and some of the others I'm going to talk about, do me a favor if you haven't already, hit that subscribe button. It only takes a second, as well as hit the like button. I really appreciate the support. It helps other people find the video. That kind of is what makes the YouTube algorithm work, which I know you guys all know, and it only takes you a half a second. The other thing is, now this you don't have to do, the other I really appreciate, but I'm going to put a couple of links in the description as well for opening an account at SoFi. If you put in $10 or more, they're going to give you a free $25. I think there are other ways to get a $275 or something, but I haven't looked at that. If you put the $10 or more, it'll give me a gift and an account I open with my son. He's only 13 years old. I try to teach him about investing and saving as well, so I appreciate that kind of support. I think it's super kind, and he gets really excited, and it's kind of what helps keep him engaged. The reality, if you have kids, is he doesn't always listen to me, so it's kind of nice when you guys do it as well. Anyway, I'm going to get into the video. I hope you find it interesting. I like talking about these funds and learning about it myself. QYLD was not one I was familiar with, so I looked it up and did a little research. So, from what I found, QYLD is kind of similar to JEPQ, which is similar to also JEPI, but JEPQ is the NASDAQ version. And in some ways, it's a little related to the yield max ones and some of the others. And these are the things I want to be careful of. It's just not what I want to invest in. Now, you guys need to do your own research because it may fit your portfolios and it may fit what you want to do. You really shouldn't just listen to me and make decisions off of that. You have to do your own research for your financial decisions. I'm just sharing what I've learned and my opinions, and that's all it is. Use it for entertainment purposes. We all have different things that we need for our own investments, and you have to actually look at your scenario, maybe talk to a financial advisor and see what really works for you. You really shouldn't listen to me or any of the people on YouTube and make decisions like that and really just delve into something. But that being said, let me explain what I read and what I saw and what I see about the fund. It's got some of the same things I don't like about the others. And in particular, it works really similar to JEPI and JEPQ, where what it's doing is it's buying an underlying equity. If I read correctly, that they're using the NASDAQ, and then they're selling at the money calls against that. What I don't like about this strategy, and I think they're doing it for a minimum of 80% of the money invested in the fund. What I don't like about this strategy, while I get it gives a dividend yield of sorts, is that they limit their upside to give that yield. So let me explain how that works. And I'll make up an underlying equity instead of using the NASDAQ or whatever, but I looked up a couple and got an idea, a rough idea where they're trading. So I looked at the Qs last night and saw where they closed was around $390. Well, if you look at a 1 month out call option, which the closest one I found expired December 29th, I want to say, and it was trading around $6. So what they're doing is they're buying the Qs at 390, and then they're for every 100 shares they buy, they could sell one of the 1 month out call option and get about $6 for that. Well, if you multiply that by 12 and divide it into the 390, it pays about an 18% return. Then if you're only doing 80% of that, you're probably putting about 11%. The problem is if the Qs go higher, you're getting your 11%. If the Qs go lower, they're going to readjust to where the Qs are at the time of it in January, where they're purchasing it, and you're going to lose that equity. So while you're getting a 10 or 11% yield, if there's a correction in the markets, you're fully at risk for the full correction, but you're limiting your upside that if the market continues higher than that you don't get to profit the way that you should. It's great if you need income and if you're not concerned about if the stock market corrects. But to be fair, people get nervous and they don't really want to go through the down phases. And I think there's a little bit of misunderstanding that this has all the risk of a collapse. If the market collapses, those ETFs are going to be included in it. And I'm going to talk a tiny bit about the yield max ones because I like those the least, because what they end up doing is they don't even buy the underlying stock. They actually just use a synthetic option to be long, which allows them to either leverage, which is putting up less money to be able to buy more than they really should. Now, they'll sell an out of the money call in hopes that they actually get some of the upside potential. But what I really didn't like about what they did is they use weekly options, and when I saw the fund manager talking about it, the reason they do that is if the stock goes lower, it gives them the opportunity to cover the calls that they sold and sell lower calls to get higher yield. Well, they're so focused on the yield, I want you to think about that. So you buy an $100 equity, you sell a 105 call for that week. The equity then falls to 90, and you cover your 105 call to maybe sell a 90 or 95 call. So you keep lessening your ability to get actual growth out of the stock if it reverses and goes higher, just to get the yield and the premium of the options. Sure, that might make it look good in terms of the percentage yield that you're paying out as a quote unquote dividend, but it just makes it attractive for people who focus on the yield and don't pay attention to whether it's going up or down in terms of the value of the underlying equity. And then they tout that you should just reinvest those dividends to really get your full potential growth. Uh, I don't think people understand that there's real risk in that, so that's why I worry about it. The other ones, there's a little bit less risk because they're using the entire, whether it's the Nasdaq, the S&Ps, the Dow, or whatever bundle they're using as their underlying equity. It's a little bit more stable, and at least I'm bullish the markets. So at this moment, like, I wouldn't be super uncomfortable with it, but I'd hate to see people using it for retirement income or things like that, because if the stock market does go through a real correction, while you'll still be getting likely a 10 or 12% yield, it'll decrease in value if the market corrects substantially. If you have a 30, 40, 50% correction in the market, for every 10 grand you put in there, if there's a 50% correction, yeah, you're still getting a 10% return, but now it's only on $5,000, not the original 10. So just be understanding of what these funds do and what they are. I have no issue with you investing or whatever people invest in. I don't even mean that the way it sounds. But really, it may not be a bad investment. I don't want to say it is. What I don't love about them is people focus and think, oh, they're invested in the stock market, it's relatively safe, and somehow they're getting these 8, 9, 10, 11, 12% return. Always understand a simple philosophy. Philosophy? No, philosophy. The higher return you're getting, the more risk something is taking to give that. It really is pretty simple. They haven't figured out some magical formula to be doing better than everybody else, or everybody else would be doing it too. It's simply that they're having to take on this added layer of risk, or giving up potential gains is what they're doing in this scenario. It's not really that they're taking on added risk, but they're giving up potential gains for immediate yield in this instance. So again, just the way it works, we buy an underlying equity and we sell an at the money call. So if the stock goes higher, the calls are taken and you don't get that growth in the underlying equity, you just get the payout in the call. If the equity goes lower, well, they do it again from a lower cost basis. If you've made enough in the 1 month on the yield to to cover the loss in the underlying equity, well, maybe you net out better than if overall, and maybe you make a couple percent, but you're still going to have the downside risk. On JEPI and JEPQ, they buy these ELNs that are supposed to protect it to some degree, but even when I read about those, they're kind of like having the underlying and an option mixed all into one. It sounds like it's supposed to protect to the downside. My guess is it isn't, because again, nobody's created this newfangled thing that just has no risk that pays 10 or 11% return. Now, the one thing I'll say, I was really excited about the stock market and the way it reacted this week in general. I think that the markets are coming to grips with the Fed's likely to start cutting rates next year. The 10-year is already going lower. So, dividend stocks, ETFs, whatever it is you're looking at, my guess is in time, if bonds start only paying 3% or 2% again, and bank accounts are only giving 1% yield, that people look for better opportunities. And by the time they think of the stock market, the stocks that are paying 5, 6, 7% return right now, and even the ones that are paying 3 or 4, are not going to be paying the same dividend, which means I think, again, you have to do your own research. I think they're probably going higher to offset the fact that the treasuries and the CDs and the bank accounts probably won't be paying the same rates in time. And if you think that through longer term, I mean, a lot of people push some of the money they had invested in stocks and real estate and whatever else into CDs, whether it was 1 year, 2 year, 3 year, 5 year. If you go out further, it didn't seem really worth it because they were getting close to 5% return. People see it as no risk. Well, if over the next 2, 3, 4, 5 years, the pay starts to drop as that matures, and you have an option to roll it into a new CD or leave it in your high yield account or whatever it is, if that new yield is lower, people might think, geez, I don't want to only get 2% or 2.5% on a CD, and maybe that money siphons back into the stock market. I think that's why we're seeing the rally. I think it really gravitates through all the companies, and the ones that are able to pay their dividends and survive even at where the rates are now. If the rates go lower, if they're borrowing, they're going to get better borrowing capacity on top of the fact that those dividends are such a steal right now because they're getting about the same or better than a CD. There's certain companies I've really loved. Now, QYLD, I don't know. It's up to you. Maybe it's important you get that 10 or 11% return. It's kind of how I look at JEP-E and JEP-Q. And again, I actually got out of those recently and went into some other items just because I didn't love that strategy. And really, the Tesla one, TSLY, I think what it showed is there's good opportunity to make money in the options. I actually bought some Tesla and started selling calls against it. Now, maybe somebody doesn't have enough money to buy 100 shares of Tesla, and this works out for them, and they're not concerned about the things I am, which is why I say you need to do your own research. But I watch every day, all day, and I look at those options, the weeklies, the 2 weeks, the 3 weeks, and whatever else. So I don't want somebody else managing it for me, and I'm comfortable doing it. But yeah, I don't see that they're wrong. It's got a 50, 55 implied volatility. That's pretty good volatility for a stock that I don't mind owning. And if I get taken on my calls and don't own the stock anymore, well, I can decide if I want to sell puts or what I want to do from there in terms of getting like working the trade. And I kind of see the value of getting some yield from owning the stock instead of just owning it outright, but it's also fun for me to trade it, and I didn't do it with a huge amount of investment that I'm uncomfortable having a little fun with. I just don't want to put into there thinking I'm going to get some 40, 50, 60% return and it's just going to be this wonderful thing, because all that means to me is they're taking on a bunch of risk. Anyway, I hope the person who asked about the QYLD that I answered the question and you understand what the fund is now. By all means, if it works for you and it's what you're looking for, you have to make those decisions for you. I just don't want any of those funds in my portfolio again. I don't have an issue with buying the Qs and selling a call against it if I want to do that myself. So have a great Saturday. Have a great Sunday tomorrow. I'll talk to you this week. Tomorrow, I'm going to talk about the account that I did the $10,000 in and bought a bunch of different stocks. If you didn't see that video, feel free to watch it. Um, it's worked out amazingly well the first 2 weeks, which isn't typical, but I'm excited to do the video tomorrow because it makes it look really good, even though I think that's just dumb luck. Again, don't forget to subscribe and like and make some comments. I really appreciate everybody being involved. Have a great day.